Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Could China's stock market and economic troubles derail the global economic recovery? Our panelists weigh in on that and other pressing issues here at the Roundtable. Senior market analyst Charles Rotblut, stock analyst Tracy Reinick, and top market technician, of course, Kevin Matris. And there's really a lot to talk about here as we get into this edition. And this is being recorded, by the way, on August the 31st of 2009. And the importance of that will become apparent as we work our way through this conversation. Because overnight, before our markets opened up here this morning, China's Shanghai stock index took a dive of nearly 7%. It's been down 21% for the month, steepest monthly tumble in about 15 years. And word on the wire shortly before we assembled here is that their economy is not sustainable. So all of that combines to tell you what about a global recovery?
Well, I think there's a couple of things. First of all, we should look at China, and I've got a chart here of the Shanghai. It actually made a huge rally up, so the fact that you have this correction, it really is still keeping on most of its gains. So even though Shanghai had a pretty steep drop today, it's still, relatively speaking, people investing in it are doing okay.
Even though it's been down 21% on the
Even though it's
month.
down 20%, you can see in the chart behind me the huge run it's had. So to have some type of correction, given that run's not surprising.
Okay.
I will point out, people are talking about FXI, which is an ETF. This ETF actually does not track the Shanghai. It's one of the few Chinese ETFs available, but I want to call it to people, let them know, and it is doing better, but it's not. Does not track the Shanghai, so it's a little. So if you see the disconnect, there's a reason for it. Mm-hmm. But I think what you're seeing in China here, and it's really worth watching what develops, because there's two things that are going on. A, people are worried about the Chinese government spending less on stimulus, and as we look in the U.S., we're starting to see some stimulus programs end, such as cash for clunkers, ended. Right. We'll see the first-time home buyers credit end in November.
Right.
Even though the bulk of spending won't happen until next year, there are questions as to what's going to happen with the stimulus, and when we pull back, what's the next step? Right now, there's a survey that was just released saying that 70% of economists think that our fiscal policy is about right.
76% actually.
Right, and you have to worry about that. We're looking at this huge federal deficit. At some point, we're going to have to raise interest rates. We're going to have to rein in federal spending.
Right.
And how's that going to happen? The other thing that people are worried about in China is a whole bunch of new IPOs, and they're worried about all that, what that's going to do to the market. And we did have a lot of companies that were taken private, and there's a lot of those private capital firms wanting to bring those stocks back to market. And at some point, they might start trying to get those IPOs out there. And there's no telling how much new supply will come out or how that will affect the U.S. market.
So with all of that as the backdrop, what does that tell us about the global recovery?
Well, you know, I think it's questionable. I think what you're seeing in China right now is unique to China, but I think it's worth watching. If China keeps wobbling, that could cause a lack of confidence in the broader world markets.
Okay.
On the other hand, you can look at a country like Brazil, where we're actually seeing economic forecasts being raised. So I think we'll have to see right now, is this uniquely a China problem, or is this a harbinger of what could potentially happen in the U.S.? And keep in mind, even if mistakes are made in China, it does not necessarily mean that Bernanke will make the same mistakes, or that will necessarily repeat what happens in China.
Kevin, you seen it the same way?
You know, Charles put up a good chart, and it's interesting because, yeah, China is going through a correction right now, but if you were to look at the Shanghai index, it is up 80% for the year. Mm-hmm. So, yeah, it is true that we're looking at roughly a 20% correction, but an 80% gain, less a 20% correction, is still a significant gain on the year. I think everybody is concerned, though, that with the Chinese stimulus package starting to wear off, what is going to happen to their economy? Even the Chinese government has instructed their banks to pull back on some of their lending. However, what everybody has to realize is that China's economy really is dependent on their foreign customers. We are one of those customers. And with our economy coming off bottom, And with only 30% of our stimulus in effect, we still have the other bulk of the stimulus, 70% of the stimulus due to hit our economy, especially given the fact with our stimulus coming out, that is going to spur economic activity. Our inventories are so low, so as inventories need to be built back up, that will spur economic activity here in the U.S., it will spur economic activity in China, and it will spur economic activity abroad.
That is a good point that you made. 76% of the economists say that we don't need a second stimulus. And you know, we used to say in the reporting business, whenever economists all agree on something, there is when you have to worry.
Right.
What do you think?
Well, I mean, we're seeing maybe, China is kind of the bellwether here. We're seeing what might happen once their stimulus is reined in, because they were crazy out of control lending, as Kevin said, in the first 6 months of the year. And now they're not going to be, at least for right now, and well, at least their stock markets don't like it. And then we're also seeing some other interesting things that Kevin also brought up about, their economy is based on the exports, and we are the ones who buy their products, and we're
Right.
not buying them.
Right.
But you can kind of see some of that in the Baltic Dry Index, which is down 45% since it peaked a couple months ago, and it just had one of its worst months ever, or at least in a long time. And so the shipping traffic isn't there. So I'm not sure how China is going to not have their own second stimulus going forward, but they're going to have to maybe do it before we are. And then another thing about the Chinese stock market that we keep forgetting is that they think about 20% of their stimulus actually went into the market. So if that suddenly has gone away, well, now it's down 21%. Maybe that was part of the 20% stimulus that made its way in there. That was all artificial. So these kind of artificial government programs have to work themselves out. And we see some of that. We're going to see it here with, Charles brought up, the cash for clunkers is ended now. And we're going to see the home buyer credit end. But we saw one home buyer credit end in California only a month ago.
Yeah.
And that was the one where they were giving out $10,000 on top of the $8,000 for new home construction. And it really spurred sales there. But as soon as it ended by about mid-July, the permits fell quite sharply in July. They were down like 14%. And the housing industry in California still sees the worst new construction numbers ever, even though they had the stimulus. So we're not quite sure. Maybe they'll extend the home buyer's credit here and that'll keep spurring us. We don't know. But China's kind of seemingly, for right now, to be a little bit of a bellwether for us.
Right.
Okay, so you're watching it with more than just a casual interest.
Oh, yeah.
I know you're a big watcher of that Asian
Right.
market out there, that region. So Kevin, as far as the pause that we're seeing on the heels of the market drop in China overnight, in our stock market over here, it doesn't really, at this point, concern you that our markets and other world stock markets took a little bit of a pause back here?
It always is concerning, of course, but, if you look at the Chinese index, you can see that nothing goes straight up. There has to be a pullback somewhere along the line. So, if we get a correction here in the U.S., I don't think it's something that should be ruled out or people should freak out about. If you look at how our market has performed, the Dow is up roughly 48% from the lows,
Right.
but we're only up about 5% for the year. So we are trailing the Shanghai index considerably, if you want to put it in that kind of context. If we do see a pullback, you can see pretty good support in the Dow at around the 9,000 area and then the 8,700-ish area. And if we were to pull back to those levels, you're talking about anywhere from maybe a 6 to a 10% pullback, far from a scary, scary pullback that some economists are predicting. But if you were to look on the upside, I still think 10,000 is a very realistic number. And then you're looking at 10.8. And the reason why I say 10.8, that was the reactionary low that we had seen last year before everybody started to price in the end of the world. So if you were to look at this thing from a fundamental perspective and from a technical perspective, I think that retesting that previous support, which would now be major, major resistance, is not out of the question. And while some people think 10.8 sounds crazy, that is only, 10 and 10.8, that's only about a 6 to a 13% increase from where we are right now. So I don't think that a correction is out of the question. I don't think it's going to be a market-ending correction, but I think everybody needs to keep this in context, and I do believe that higher prices probably will be seen by the end of the year.
Tracy, we've had the best August in the stock market here in the U.S. in 9 years, but as you pointed out in one of your recent market comments that I saw, there is really little in the way of a fresh catalyst to keep that summer stock market rally going.
Right. It'll be interesting to see if we do have a little bit of pullback here. There's kind of two camps. Will we have people who've been waiting on the sidelines for some kind of downturn suddenly rush in? Or will we have a bigger overall panic, oh, this is the turn down and I have to get out now before it's too late kind of thing. So it's unclear which way we might go. It'll be interesting to watch.
Okay. You know what I found curious this morning, kind of quickly here, is that even two big business deals that came, word of which came across this morning, the Walt Disney Marvel Entertainment combination and Baker Hughes taking over BJ Services, was not even enough to, news of that was not even enough to offset the effect of the China drop.
Well, I think that's partially a reflection of volume. We've seen volume trail off, and I think that'll continue to happen this week. Really, it's a vacation week. A lot of people are leaving early. I kind of expect volume to probably be along the lines of what it was this past week until about Friday afternoon, where everybody will just leave and it'll just be a few guys, and probably can hear a pin drop in the New York Stock Exchange. But I think what you're seeing, though, there was a reaction this morning to China. You also see oil pulled back, and that kind of took some money out of the stocks as well.
Right.
But I think when we've looked at China before, when it's wobbled on a Monday, it's caused stocks to pull back. We've actually seen the Dow and the S&P rebound. And in fact, if you look at last week with the Dow's 9-day winning streak, a lot of those gains were really afternoon rebounds when the Dow fractionally got up there. I do think people are concerned about China, but I don't necessarily think it's the sign of the correction we've been waiting for, or some people actually think would happen. We're still in this low volume market where the fast money is pushing stocks around. And if we get some economic data out later this week that really confirms that, yeah, we're still in stabilization, yes, we're moving closer to recovery, we could actually shake off this morning's fears and actually see the market go a little bit even higher. A little bit of resistance at 9,600, but I think, as Kevin pointed out, I think the big number's at 10,000. And I do think there's some traders that would like to see the Dow get up to that level.
All right, that's how they see it here as far as our panelists are concerned. Keep an eye on Zacks.com for any updated commentary on these and other issues. With all these folks, I'm Terry Ruffalo.